Congress and the IRS make moves to improve taxpayer compliance for tax cryptocurrency transactions. I think it was a couple weeks ago I mentioned the executive order. They've been talking about this executive order coming from Washington. It's coming. They mentioned that it's probably going to be this week if they do come out, and it is monumental as they predicted. We'll probably cover it maybe a Crypto Thursday. And not wait till next Tuesday, but we'll see what happens on that. So this is a pretty good article about taxes. IRS Commissioner Charles, I don't like to talk about him, testifying before Congress in April, estimated the gap between taxes owed and taxes collected in the United States. And I quote this all the time, but you can't really find this anywhere because the difference between what he says here and what they say now or what they always said is very different. So he says that it's close to $1 trillion. Now remember, this is in the midst of the Build Back Better, April 2021. March, they had passed the American Rescue Plan, which put in the Venmo reporting requirements that nobody knew about. And then they were pushing for the Build Back Better. And part of the Build Back Better plan was to lower the tax gap. And so it went from somewhere like 200 billion, which is, usually the numbers are 200 billion, 280 billion, 300 billion. And all of a sudden it jumped to $1 trillion. While there is some debate as to how much lax reporting on cryptocurrency transactions contributes to the so-called tax gap, with the market capitalization hovering at the time of this writing around $2 trillion, well, then it can't have much of it, can it? Cryptocurrency investments have increasingly become an object of regulatory scrutiny, and we cover that a lot on the show. The regulators are after cryptocurrency. Beginning with Notice 214, this is when they recognize that cryptocurrency as a property. The IRS has consistently taken the view that cryptocurrencies are property for the U.S. federal income tax purposes, absent any specific statutory regulatory exception. U.S. individual taxpayers are generally required to report gains realized on the sale of property, including cryptocurrency, and pay tax on these gains. To remind taxpayers of this requirement, and I've showed you the from 2019, and the first time that crypto question appeared on Schedule 1 of your 1040, and then 2020, it appeared on the first page of your 1040 form, and now it's there again, a little bit different language. So that's what we're going to review here today. To remind taxpayers of this requirement, now Form 1040 now specifically asks taxpayers whether they have received, sold, exchanged, or otherwise disposed of any financial interest in any virtual currency. The instructions define virtual currency for this purpose as a digital representation of value other than a representation of a real fiat currency that function as a unit of account, a store of value, or a medium of exchange. Cryptocurrencies are included in this definition. The question on 1040 requires an affirmative answer of yes or no from all taxpayers. And again, you're answering under penalty of perjury. So you have to be truthful. A version of the virtual currency question was included on Schedule 1 of Form 1040 when it was introduced in 2019. But beginning with the 2020 tax year, the question had a more prominent position on page 1. At that time asked, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? The wording of the question has been modified for the 2021 tax year to remove the word send and replace otherwise acquire with otherwise disposed of, consistent with the IRS's focus on identifying taxable events involving cryptocurrency. Because there is not a taxable event if I acquire cryptocurrency, it becomes a taxable event only when I get rid of it. Now, it can be taxable, I guess, if I acquire it through my labor or selling goods, then it could be taxable. Generally, any transaction involving cryptocurrency during the tax year will require a taxpayer to answer yes to this question, with the exception of purchase of virtual currency with real currency with no further activity. Expansion of 1099B and 8300 reporting to digital assets. During his congressional testimony, the commissioner recommended that Congress pass legislation requiring information reporting for cryptocurrency transactions. The Infrastructure Investment and Jobs Act, this one passed, it shouldn't have, signed into law by the President Biden on November 15th, does this. Again, should never have passed. Under the new law, any person who, for consideration, is responsible for regularly providing any services effectuating transfers of digital assets on behalf of another person is a broker for purposes of Internal Revenue Code Section 6045 and required to report those transfers to the IRS on Form 1099-B. This act defines digital assets as any digital representation of value which is recorded on a cryptographically secured distributed ledger or any similar technology as specified by the Secretary, except as otherwise provided by the Secretary. A broad definition with the potential to encompass range of crypto assets, including perhaps non-fungible tokens. I think for sure it does include non-fungible tokens. Failure to comply with this reporting requirement would trigger penalties under IRS Code 6724. This definition of broker, as amended by the Act, has been criticized by some members of Congress and many in the cryptocurrency industry as overbroad, as the language would potentially pick up other participants in the cryptocurrency ecosystem, such as miners and wallet developers, rather than merely cryptocurrency exchanges. A bipartisan group of legislators attempted to revise the language to address these concerns, but the proposed amendment did not make it to the final bill. While it remains to be seen how the U.S. Treasury, which will be tasked with implementing the new reporting requirement, will interpret the language, unofficial statements from the Treasury indicate that it will not seek to enforce this requirement against miners and hardware developments. Yet, my own opinion is I think they will, because that's why they always promise to do least and then do the most. That's just the nature of regulators. The Act also amends Section 6501 or 6050I, which generally requires taxpayers who receive over $10,000 in cash in the course of a taxpayer's trade or business to report this receipt to the IRS on Form 8300 to apply to receipts of digital assets. The new reporting requirements are effective for returns required to be filed and statements required to be furnished after December 31st, 2023. Okay, so right now you go to a place, you buy something on a credit card, it costs you $11,000. That's not you don't have to report that, right? Because that transaction's reported from the credit card company. But now they're saying, hey, if you do that, if you give cryptocurrency, that's like giving money, then you have to report it. And that really puts a damper on using cryptocurrency. The new reporting requirements are projected to raise an additional revenue of $28 billion over the next 10 years. Yeah, right. According to estimates prepared by the Joint Committee on Taxation, a sizable sum, though unlikely to make a significant impact on the tax gap. Other potential legislative, because to make an impact, then that has to be things that's not reported now. But many people do report it. Other potential legislative changes affecting the taxation of cryptocurrency transactions are currently under consideration by Congress in the Build Back Better plan or Act. We really have to object to this Build Back Better Act. They want to give $80 billion more to the IRS, more than double the employee size of the IRS. It's something we have to oppose, which was approved by the U.S. House of Representatives only to stall in the U.S. Senate. This would extend, now this is important stuff here, this would extend the wash sale rules of Code Section 1091 and the constructive sale rule of Code Section 1259 to cryptocurrency assets. Now, pay attention here. This is very important. A wash sale is a strategy that effectively provides an investor with a tax-deductible loss while maintaining the position to an investment. So if crypto's down, I bought it at, I buy crypto, say I bought Bitcoin at 40,000. It goes down to 32,000. I sell it. I've taken a loss of 8,000 and I buy it back at 32. So technically I still owe the same amount, but now I've taken an $8,000 loss and I can take that loss against other capital gains, even though I'm still holding the currency. That's what they're trying to get rid of. And and it is an advantage. I'll give you that. Code Section 9 disallows immediate loss deduction in circumstances where a taxpayer sells at a loss and requires the same assets of something substantially similar within 30 days before or after the loss sale, but is limited by its terms to loss sales of stock, securities, and certain options. Because cryptocurrencies are not considered securities for purpose of these rules under current law, crypto investors have been able to obtain the tax benefit by harvesting tax losses during market downswings without actually cashing out of their investment. Well, they cash out, but then they can cash back in. The constructive sale rules in Code Section 1259 are intended to address the reverse situation. A taxpayer effectively liquidates an appreciated financial position without recognizing taxable gain. Under current law, disposing of an appreciated financial position in any stock, the debt instrument, or partnership interest in a short sale or futures of forward contract for the same or substantially similar property is treated as a constructive sale and therefore a taxable event. The Build Back Better Act would limit use of both of the wash sale and constructive sale strategies by cryptocurrency investors by extending application of these codes to digital assets such as cryptocurrency. It remains to be seen whether Congress will revisit these proposals in 2022, either as part of the Build Back Better Act or a standalone bill. However, the proposed changes suggest growing interest in Congress in closing what some perceive as a tax loophole with respect to these asset class. The changes to the wash sale and constructive sales rules discussed above were estimated to raise $16.8 billion over 10 years per the joint committee. It won't raise that much money because nobody will use it. As they say, if people keep doing what they're doing, then this would raise this much money. But if the wash sale rule wasn't there, then they wouldn't raise that money because people wouldn't do it. Just makes sense.